struggling with the NVIDIA position. So we declared that we want to initiate the NVIDIA position, but now we're struggling a bit because we don't really know how to handle two problems. One is, should we sell something, or related to that, should we increase our leverage? So we're a little bit in a tough spot here. And again, this is the purpose of this podcast, is give people a sense for what it feels like to run a hedge fund. So these are very, very important thoughts that I encourage anybody who is interested in the hedge fund business to at least try to share, try to listen to this, and let's go from here. This is Not Even Wrong podcast. It's November 22nd, 2021. This is Krim Delco for the day. The fund is up 3.5%. The market is up 65 basis points. For the year, we are up 52.4%. The market is up 23.5%. We're outperforming by 28.9%. Main outperformer today is Tesla. We actually have a massive outperformance by Tesla. Unfortunately, our biotech index is down quite a bit, actually. We're losing 2% in the portfolio through the biotech index in a market that is up. Actually, NASDAQ's flat, but when I talk market, I usually use the S&P 500. So in an up market, we're down quite a bit in our biotech index. And this is right at the core of the problem. So we want to increase our NVIDIA. We basically want to initiate an NVIDIA position. We have invested in the past. We've then sold again. And we have our thoughts, and whoever wants to know the basic thesis, please go back, I think 2 episodes ago, we talked about why we want to initiate NVIDIA. So this episode is not about why, it's more about the how. The problem is we're at this point at about 12% leverage, so 112%. So our assets are about 112% of our equity. So we have 12% leverage. So if our equity is $100, we have $112 worth of assets in the portfolio. Why are we doing this? Because interest rates are low, we have high conviction, so we want to make a little bit more money through basically borrowing money. And the question is, should we borrow more? Should we borrow more, increase our leverage? And the answer for that is twofold. I mean, one is, you want to increase leverage as much as you can under the constraint that you can sustain a massive, massive drawdown. This is the problem. So we don't have a problem with NVIDIA as a business. We don't have a problem with NVIDIA long-term at all. We think the company can be worth several $1 trillion easily, based on our thesis that basically a lot of the AI that we know today will go into the virtual world. This is the fundamental thesis of NVIDIA. So having said that, now the question is, how are we going to increase our position in the portfolio? Either we increase leverage or we sell something. We have Tesla is our largest position, and then we have Bitcoin, and then we have our biotech index. We consider Tesla our cost of capital. So we consider Tesla the best performing stock, expected to perform the best in the market going forward. So anything we buy has to do better than Tesla. In other words, also, we're not going to sell Tesla unless we can, with very high conviction, find something that we think will do even better. But the way we look at the world today, we believe that nothing will do better than Tesla, because Tesla is combining all of these things. Tesla is better than NVIDIA, Tesla is better than Bitcoin. And on the biotech side, there is potential that the biotech index actually outperforms Tesla, but the risk is much higher there because it's biology and it's less engineering and more scientific risk, and therefore we believe that the risk reward for Tesla is much better. So in other words, we don't want to sell Tesla. That's what I mean. Our cost of capital is Tesla. We don't think that anything risk adjusted can do better than Tesla. So why don't we have all our money in Tesla? I mean, that's a good question. And actually, I need to answer this question before I even go further. So why don't we just put all our money in Tesla? Well, one reason is that there is a potential with the biotech index that it outperforms Tesla. The risk reward is not as compelling, but let's say we still want to have a foot in the door there because it's just too enticing. CRISPR is such a revolution, such a fundamental, it's the invention of the transistor. It's too big to forego. So we want to have something in there, and we do. And on Bitcoin, it's kind of the same thing. I mean, if I'm right on Bitcoin, if my whole thesis that this is kind of like the Renaissance and the Medici and the invention of the law and the invention of accounting and the whole restructuring of a society, if Bitcoin is in the realm of that kind of massive change in the power structure of the world, then it's just too big to forego. So in that sense, we want to be invested in those two, not necessarily because we have high conviction that they're going to do better than Tesla, but it's kind of it's a long shot, and the long shot is worth it. So it's more like a venture capital type investment. If I'm right on this, I don't need to do any ROIs. If I'm wrong on this, then I'm going to lose some money and forego for returns on Tesla. So now let's talk about NVIDIA. So do we want to sell things? The answer is no. Given all this, what I just said, NVIDIA doesn't fit either. We don't think NVIDIA will do better than Tesla. Although in the past, it's been, depending on when you look back, sometimes NVIDIA did better than Tesla, sometimes Tesla did better. But if you just go back, let's say, to 2014-ish, something like that, then actually NVIDIA has done better than Tesla. If you go down 2012, so if you go back all the way to 2012, when we believe the machine learning 1.0 started, then Tesla has done better. So having said that, it's basically a long shot, and we still have much higher conviction in Tesla because the impact of Tesla is large. It's still a physical world, and maybe this is an old-fashioned view of the world. Maybe we shouldn't be thinking like that. Maybe the build out of the omniverse, as NVIDIA calls it, is actually a much bigger deal than building stuff in the physical world. That remains to be seen. But let's say we don't want to sell Tesla to buy NVIDIA. We're not ready to do that. There's also some tax implication, by the way, which I don't want to discuss here, but not selling Tesla seems to be the right way. So then the other question is, okay, should we increase leverage? And this is a little bit of a tough one. We have a lot of bad things happening in the world, in particular what's happening in the United States. I think the Biden administration is kind of like a chicken without a head. We don't have good leadership in Washington. We have, in fact, terrible leadership because we don't have leadership. We have a massive bifurcation of society into left and right. So there's a lot of potential for bad things happening in the United States. There's been some reversal to that. The massive move to the left has been, I would say, counteracted. I mean, even in San Francisco, we had, let's say, a recall of a very controversial decision to basically get rid of our high school magnet school. We have a couple of things that RDA is saying in San Francisco in terms of violence and theft and things that they didn't want to pursue anymore, and the city basically turned into a zombie zone. And I think there's a little bit more police on the streets. So there's things like that. Again, this is not a political podcast. I'm just saying we have a bit of a swing back to the middle from the extreme left since the Biden vote. Since Biden got voted into office, and I would say the country went definitely very extremely far left. So we have some good things, but nevertheless, we have problems in the world, and the markets are frothy. The markets are frothy because we have low interest rates. We have the yield curves falling, which is kind of good for risk assets, but it's not the best thing for future for the future of the economy. So there's a lot of mixed signals, and all I'm talking here is I hope listeners to this podcast have understood by now that we're not in the business of forecasting short-term market moves. But when you have leverage, you have to think about this thing a little bit deeper. And unfortunately, we can't. I mean, the reason we don't predict short-term market moves is that we really don't have any tools or technology to be good at it. But we have to do something if we want to increase leverage. Our leverage right now is relatively low, but that's not because we lowered our leverage. It's because our assets have gained a lot in value, and therefore our equity is up a lot. And that can change if we lose 50% in our equity. Okay, so let's do the math, actually. I mean, I'm talking here around the bush because I really don't have an answer. But the math is the following. So we started with roughly 20% leverage. So we started with, let's say we had $100 in equity, we had $120 in assets. We are up 50%. So our $100 went to $150. So our leverage went from 20% to 20 divided by 150, which is roughly, what is that? 20 divided by 150 is something along the lines of 12, 13%, something like that. So we reduced our leverage just because our equity went up, which is a great thing. Now, if we increase our leverage, if we go back to 20%, so now we're going to have 20% of 150 would be $30 in leverage. And if we go from 150 down to 100 again, so if we have a drawdown of 30%, then we would have 30% leverage, which is above the threshold that we're comfortable. We believe that we shouldn't have more than 25% leverage. And the idea is to be in a position when the market has a drawdown to get to that 25% leverage. And then if we have a very high conviction, maybe add some positions back then and maybe increase the leverage short term when there's a massive drawdown. But we don't want to increase leverage when we have frothy conditions in the market. That's the fundamental statement here. Now, the question is, how do we know it's frothy? Maybe it's not frothy. Maybe because everybody's so scared, it's not frothy. That's potentially true. I don't think that's wrong. So let's think about that. So if everybody's concerned about a market correction, then who are we to judge? I think one of the biggest fears actually that we have is that, and this is anecdotal, but we believe that a lot of hedge funds, a lot of traditional hedge funds, so the Druckenmillers of this world, the Ackmans, these types of people, and that's really just a feeling. We believe a lot of these people are concentrating a lot more, and they're concentrating in the stocks that we're actually looking at, in particular Tesla and NVDA. Maybe not so much in the CRISPR index. They're concentrating a lot. Why? Because those stocks have been working. So whatever we can see on the charts, they can see too. And these people are sick and tired of making pedestrian returns. Because no matter if you're a diversified portfolio, even in this market, at best you maybe are at market, at worst you're much even lower. So the only way to make money in this market, even though the market's up quite a bit, we're talking 23.45% for the year, but it's been driven by a few massive outperformers. One of them Tesla, the other NVIDIA. There's a few others. Apple is one of them. So people are concentrating in those stocks, and this is a big risk that we don't like. And the problem with all these things is always the same. So you're going to bed with these people, and you know how they operate. Maybe Druckenmiller is prudent enough not to put too much leverage, but I can guarantee you, once Druckenmiller starts buying NVIDIA, a lot of people on Madison Avenue and then Third Avenue, which is sort of the second tier of hedge funds, will start doing the same thing, and they will start adding leverage. And we're back to Miller Mondigliani. I don't care what the company does, how prudent Tesla or NVIDIA manage their balance sheet, the investors will take care of the leverage themselves. So even if NVIDIA and Tesla look like safe companies, they have lots of cash on the balance sheet, we shouldn't be concerned. We should absolutely expect that the investors in those companies, so basically the public, will put on a lot of leverage, or some sort of optimal leverage, whatever that may be. And they will overdo it, and then there will be a correction. And this is exactly the risk. So should we, in that context, follow suit, or should we stay put? This is the big question. And my gut's telling me we should stay put. That's what my gut's telling me. We're going to miss NVIDIA, potentially, if we're wrong on this correction thesis. But we don't want to be in a position where we follow suit, where follow these people who concentrate. NVIDIA is, as a company, incredibly highly valued. Very, very highly valued for good reasons. But we also have to believe that there is something like froth in the market, because everybody's concentrating into NVIDIA. Not just, but it's one of the stocks that everybody wants to own. And unfortunately, we should be trying at least to follow suit of what Wall Street always likes to be, which is a provider of liquidity. We don't want to be a consumer of liquidity, which means we don't want to be doing what everybody else is doing. We want to be a little bit contrarian. In this particular case, we have to go against the grain. Yeah, we have to go against our own grain, and our own grain tells us we shouldn't be buying NVIDIA at these levels, not because NVIDIA is expensive. We don't believe in valuation when it comes to these types of companies, because we don't know how the omniverse is going to evolve, and none of that stuff. We just believe that there is a lot of froth in the market, and there's a very good chance of a correction. And the same applies to Tesla. And if we have a 30% correction in the portfolio, we would go at this point to about 20% leverage, which is decent, palatable. But if we add another 5, 6, 7% leverage, then that 30% correction would take us above our 25% threshold. And this is kind of where we just start becoming uncomfortable. It's not a hard line, but we would like to reach the line in times when there is a massive correction, so we can maybe add something instead of doing it now. So this is the conclusion here. We're not gonna buy NVIDIA right now because the only way we can do it is by adding leverage. Adding leverage means we don't want to sell any asset to free capital to buy NVIDIA. So the only way we can buy NVIDIA is by adding leverage. And we decided, based on the discussion we just had in this episode, based on things like that everybody's concentrating, and there's a kind of a game theoretic problem happening in the market where a lot of people with good names, hedge fund managers that other people want to follow, they decided to concentrate, and that creates the frothy conditions in the market because then everybody's following into those types of stocks. The reason we believe that is it's not based on data. Maybe somebody who has better data can refute this or confirm it. But we believe if you look at stocks like Intel or RTX or Boeing or even GM, they've done okay this year, but there's certain stocks like NVIDIA, Moderna, BioNTech, and Tesla, and Roblox, and yeah, they just have done a lot better. And I think the reason they've done a lot better is because people are concentrating into those types of stocks, and we don't want to be doing the same thing like those people. Hence, we decided not to add NVIDIA at this point. Thank you.